I'm Ben Reppond. Welcome to my YouTube broadcast. Today is the 29th of January, 2025. Almost to the end of the month of January. Can you believe it? Let's jump into the dashboard. Take a look at what went on last week. And you can see that this is data as of last Friday. Generally speaking, the market is positive. It was a positive week in most sectors. We get to some of the sectors and you'll see that some of them are negative. But you can see in the yellow box, beginning with the developed markets, the Dow, S&P, NASDAQ, which sometimes is up high, is down in fourth. And then the Russell 2000, and then the emerging markets. So the emerging markets and the developed markets, EFA and EEM, are diverging. So you're seeing that, not a lot, but I mean the developed markets are definitely leading all six of these indicators. And then at the very bottom, you have long-term government bonds, TLT, which is pretty neutral so far for the month of January. When you look to the right of that, you can see green dot or red dot. Green dots are, they are above their 20-day moving average, or above it, or they're below it, red or green. And there are 19 out of 28 that are positive, that are above their moving average. And then compared to last week, there were 16. And of course, bonds are still all negative for the year as far as relating to their 20, 50, 100, and 200-day moving averages. When we get to the sectors, mostly positive, but you can see there's a little bit of negative still in there. On the week, energy, which sometimes is all over the map, is negative. It's number 2. But for the year, it is also number 2, but positive by over 6%. So that's a defensive asset. So that would tell you that, it's kind of a bearish indicator. So looking at the year to date, it's interesting to see how these stack up. Year to date, which is, not even a month yet, you've got, going from top to bottom, industrials, fairly defensive, energy for sure defensive, basic materials defensive, telecommunications, financials, healthcare, technology is way down at number 8. 7. So it's more of leans, the list of sectors, ETFs and sectors, leans more on the defensive side. And there are 33 out of 44 that were positive, and compared to 39 the previous week. Okay, so this is the S&P 500. So when you look over this 2.5-year period of time, you see it generally is going from left to upper right. And I put a red line below the moving average. Now the moving average, because this is pretty straight line, is moving straight. You can see that with the black arrow. But the thing I thought was interesting, and sometimes this happens, is that the line, the 20-period moving average, not 20-week or 20-day, but 20-period, meaning every move equals 1 week, that when you put the moving average underneath or on top of the S&P 500, isn't it interesting that in the last month, the last year, maybe 15, 16 months, 4 times the S&P has come down and touched the moving average and bounced off of it. And in technical terms, that's called providing support. It comes down, it gives support to it, it goes back up, and vice versa, but it never pierces below the moving average. If you go back further, during the year or so before that, it did go through the moving average and drops on down, and that's when investors have to be careful if that happens. But otherwise, investors that use technical analysis will look at this and say that is basically a buy the dip approach to the market. When I put this on a candlestick chart, you can see that it moves a little differently from the candlestick standpoint, because they do actually go below the moving average. But when it's hollow, that means that week is probably starting here and moving up to here, generally positive for the week. When it's red, it means it's starting here and moving down to here, so that's generally negative for the week. So this is interesting. So this is a relative strength chart showing the NASDAQ, a growth index, compared to the S&P 500, the broad market, which includes value and growth. And over time, you've seen that that's gone up. But if you look back over the past year or so, the last piece of that chart, you can see that it's gone up and down. And in the last month or so, it has drifted down. And what that tells you, that favors the S&P as being stronger than the NASDAQ. When it goes up, the opposite is true. The NASDAQ is stronger. But it has not had a sustained period of growth, using the growth portion of the S&P. So again, a little bit more on the defensive side. I don't read this as a market that is favoring growth stocks. When we actually look at it from that standpoint, growth and value, not the S&P, I'm just taking the S&P and pulling it apart and looking at the growth segment of it, SPY G, and the value segment of it, SPY V. And you can see that clearly in the last couple of months, it has moved up. Now, there are periods, you can see those, where it has clearly moved down. Those favor value. But when it moves up like this, this is favoring growth per se over value. And I'm kind of not dealing with the S&P itself like I did in the previous chart. The S&P compared to the large cap, these are the 500 largest companies on the stock exchange, compared to the smallest 2,000, which is the Russell 2000. IWM is the ticker for the ETF. You can see when it goes up, it favors the S&P. When it goes down, it favors small cap. And you can see it generally has moved up, so large cap over time has done well. But again, looking over the past year or so, it has gone up and down a lot. Small cap coming into favor, large cap coming into favor. Long-term government bonds just are not doing well. They have not been doing well for a long time. This is a 5.5-year chart, so I drew a line, just kind of the start to the finish, showing you how badly they are doing. What this tells you is that bond yields and interest rates, the two are correlated, bond yields and interest rates are generally going up, which means the price of government bonds are generally going down. Look at the number of times where the bonds, the long-term government bond, TLT, tried to go up. It has this move up, and then it collapses. It tries to go up, and then it collapses. Throughout that 5.5-year period of time, including the recent period, it has tried to go up and keeps falling back down. Why? Because I believe interest rates are going up and bond yields are going up, which is pushing bond prices down, or the perception that they are going to move in that direction. So not a good picture for bonds. Now, where do bonds come into play? They come into play with buy and hold portfolios, 60-40, stocks and bonds. Most people use a financial advisor. Not everyone, some do. Most do, actually. And financial advisors buy into the philosophy of buy and hold Stocks and bonds, 60-40. That generally, it's true in the vast majority of cases. And so what do bonds have to do with that? Bonds are the 40. Stocks are the 60. So when bonds go down, 40% of that portfolio has got a weight on it that's pulling it down. So, and then stocks have their own up and down periods. But so if you're looking at a portfolio and you use the 60-40 approach, and you're looking at that thinking, the market went up 20%, why did I go up 8% or something? And you think, well, that's why. Because they're putting a weight on it, pulling it down. I don't use that approach. I use a tactical approach with equities only, and I stay away from bonds. I've been doing that for a long time. And but this approach of using bonds and stocks has been taught in the business schools for decades, and is generally agreed upon. And if you use a conventional thinker, conventional financial planner, financial advisor, it's likely that they will have bonds, and sometimes quite a bit of bonds in a portfolio. But this tells quite a bit of a story. The US dollar has been going up, staying above its 20-period moving average for a long time. And you can see where it is at the far right of the chart. It came down a little bit this last week. You can see that. But there is strength in the dollar, again, particularly against other currencies. And this tells that story. Gold, again, has been going up a lot. And you can see at the end of the chart, it's moving, it's up and moving up further. And, you know, that those who have been accumulating gold like this, this is the ETF, gold, GLD, which is the proxy for gold. I don't like buying paper, particularly with related to gold, the gold miners or the gold ETF. I like owning the physical asset. I like owning gold or silver. I actually buy silver. I don't buy gold. But either one is okay because you have a tangible asset. It has intrinsic value. The paper that is behind gold, GLD, that's a piece of paper. That's a stock. Does that have intrinsic value? No. It is a piece of paper. And if you're buying, like I do, if you're buying gold or silver for the purpose of having something with intrinsic value, this might move in the direction that gold is, but it is not gold. And it does not fill my purpose of trying to buy something that has intrinsic value and insurance policy, if you will, if it's ever needed. Silver kind of moves in the same direction, but it has lagged gold and is still lagging gold. It's below its 20-period moving average. Over time, it's moved in an upward direction, which I show in the black arrow, but you would have to say that gold at this point is stronger. That's not why I buy silver. I don't buy it for that reason. I buy it because it's an insurance policy. But anyway, both had a positive week. Bitcoin kind of had a not a pullback, but it did not advance much this past week. It kind of flattened out, but it has also been moving in an upward direction over this 2.5-year period of time. Volatility index. Now I know this looks like I kind of scribbled on a piece of paper. I did not. This is volatility. Volatility goes up and down. And so when the market goes up, as you've seen from the data I've reported, when it goes up, the volatility index tends to come down. And that you can see that it has come down from, well, heck, it was back in the summer, it was up around 23. And recently it was up around 19, and now it's down at 14 something. So that shows that it's basically moving down, which meant the market is generally probably moving up. Excuse me. The Asbury 6 has reported that all 6 of their indicators are positive. So that's good validation, the market's moving up. The cross-asset relative performance chart showing the last three columns, showing the last week, the last month, the last quarter. Is one asset doing versus another? A relative strength approach, one divided by the other. Stocks stronger than bonds. High beta, high volatility, better than low volatility. Large cap, better than small cap. Going down to bonds, high yield, better than high quality, and short term, better than long term. So those are the ones that hit all three time periods. U.S. versus the world. Well, Europe has been stronger than the U.S. in the last week, month, and quarter. Italy, Germany, France, and the Eurozone, all more positive than the U.S. market. This is not the currency and this is not the economy. This is the market. The U.S. is stronger, however, than the following countries: Peru, Hong Kong, India, and New Zealand for all three time periods. This is the U.S. market using SPY as a proxy. SPY compared to EWY for South Korea. I'm just picking on South Korea because the chart is just a kind of a compelling chart. Remember what I told you earlier, that when you saw that that line bouncing off of the moving average, that's exactly what's happened here, is that the moving average has provided support for the relative strength of the U.S. market compared to the South Korean market. So it's not the market, it's the difference between those two. Gold and silver. Gold is up to $2,722 an ounce. That's a 3% move up from 2 weeks ago. I did not do this last week, so that's a 2-week improvement. And silver is down 0.4% at $30.84. Now, these are the spot prices. It does not include the retail markup. The ratio of gold to silver is 88:1. A monster box of silver, 500, they're not coins, they are actually, it's called bullion, but it's 1 ounce of virtually pure silver. 500 of them now sells for $15,975, almost $16,000, and that's a markup that includes a markup of $1.11 per ounce. That brings the price per ounce, including the markup, to $31.95. And this is courtesy of my son Preston, and who is in that business. Okay, well, thank you for watching. If you have questions or comments, leave them in the comment section below.